All right, we got the recording starting here. We're just going to do a global macro update talking about some statistics here coming from the Fed today. Really didn't have any much of an impact too much today. We did get a little bit of a bear move within the S&P. Definitely not in short territory right now. I'm going to be real cautious for the second attempt of this short, but yeah, we'll see how it goes. We got a pretty decent video jam-packed for today, going over some economic stats. We kind of go over the similar stuff because we are mainly looking at the United States, but we will look at some indexes in different parts of the world as well. Canada, Germany, UK with the FTSE 100 and some other stuff. So let's get this recording started. Hey traders, welcome to another Global Macro Update. We're going to be going over a bunch of different economic statistics that are coming out, as well as a quick look at the charts, looking at S&P, looking at the different indexes around the world. So first things first, from yesterday's video, we got our new report for initial jobless claims. A lot lower than the forecast we can see, but hey, or higher, I guess, a lot higher number of people who are actually unemployed and getting unemployment insurance, but that clearly is not been affecting the market too much. This is a weekly statistics that comes out that has really had no effect on the market. We'll look at the chart here very shortly. But first, I wanted to discuss inflation around the world as a avid cryptocurrency market participant, I guess you could say. Obviously, inflation is a hot topic, talking about the Fed going brrr, printing as much money as they can, as they want, which obviously is inflationary over the long term. We're looking for that velocity change. We're looking for the second ingredient for true inflation to be coming into the market. But right now, around the globe, we're not seeing a lot of inflation. We're actually seeing deflation, meaning that the prices of goods and services are actually going down. In Brazil, very, very minimal. This is monthly and then yearly. Canada, actually deflationary. China, deflationary. Germany's basically sitting at nothing. Greece, a little bit. India is actually deflationary. Japan, no surprise there. We've talked about Japan a lot. Russia's basically even. So we're not really seeing big numbers here. South Korea and Spain is deflationary. United States is actually deflationary this month for the month of March. And overall in the year, we're not really seeing a whole lot of inflation for the inflationary yearly basis. So just in terms of how much the actual price of goods and services are going up, you're not seeing huge price increases just yet. And why is that? There's lockdown, goods and services are not being used, transactions are not taking place. There's a huge nosedive in the velocity of not just the United States currency, but currency around the globe, basically. Not every single country, but a lot of the first world countries are facing very close to deflation or very low amounts of inflation. So, we saw this yesterday, just talking about it. Total vehicle sales. They will be coming out with this month very soon, so we'll see how that goes. March was an absolute capitulation. We'll see how this upcoming month will be for the vehicle sales. I presume that's going to be even lower than what we had in March. 11.4. Then we're going to get into the 2008 era right down there. So we'll see how it goes. Personal consumption expenditures, we see it decreasing. We see people are spending less money. We see that in Q3 2019 and then Q4 we got a bit of a drop, and then Q1 2020 we're already seeing a significant decrease. So I think this will slow down even more. Consumers will be consuming less due to A, the fact that a lot of places aren't actually open, and B, they're saving for a rainy day because they don't know how long this is going to go. They heard about their friend losing their job, their brother, sister, whatever it is, and it's very uncertain of an economic situation. So in my opinion, as a individual living in society, at this time you're not going to be living beyond your means. You're going to be living within your means, saving for that rainy day, because it's a very uncertain time right now. We got the GDP numbers yesterday. Right here, GDP for Q1 forecast was -4. It was actually -4.8, but hey, apparently that's good news for the market. We actually went up that day. How the hell does that make sense? No one knows. We're a complete fantasy in terms of where the economics are, what numbers we're seeing versus the actual price action of the S&P 500. We've been seeing this number increase, seeing more and more people file for unemployment as the correction has taken place. So yeah, as time goes on, I'm kind of throwing out fundamentals out the window, to be completely honest with you, because we've seen the numbers get worse and worse. We're not really seeing much of a change in terms of the actual direction and momentum of the stock market. So at this point in time, I'm going to be mainly focusing on the charts, the price action, not really going to be going and looking into the fundamentals, because right now, the market doesn't give a single shit about what is happening in the real world economy. It's just saying everything's fine, there's not a problem. We actually posted this, which I thought was somewhat relevant in terms of what we're seeing within the market. Let's just zoom up a little bit. This is currently what I think the market is doing. The economy, the true economy, it is up in flames. Obviously, lockdown, oil prices absolutely in decimation. A lot of oil corporations cannot make a profit. They have no more supply. They can't put it anywhere. They have to pay people to store their what they thought was an asset, but is turning out to be more of a liability in terms of how much it's costing these companies. But there's a lot of shit going down, and it's not very positive. And the only sentiment for the bulls is it's priced in or it's forward looking, where how do you know that it's going to get better? COVID, the lockdown, there's no real definitive date when we're going to get out of this lockdown. We've seen authoritative countries like China really aggressively try to curb the spread, to eliminate the virus, and they're still having troubles. Right? They try to open up the economy and people are not going out. People are not going to restaurants. There's still social distancing that has to take place. It's not like it's a flip of a switch and the economy will be 100% fine and dandy again. I just do not think that is something that can occur. So I'm going to have my short bias. I'm not going to be looking for longs. And yes, I could be losing out on this bounce, but hey, this is my bias because of the actual numbers that are coming out. Not this fantasy land that the stock market is going to get held up by newly printed money and the Fed is going to save the day and everything's going to be fine and dandy after this goes away. How the fuck is that possible? I don't think it's possible, so I'm going to stick with my bias, even though I did take a loss on the SPX within my swing trade. I've accepted it. I ate that loss. I'm happy to do it, and I'm going to stick with my bias because there's just no fucking way that we're going to get out of this economic situation in my personal view. All right. This was the initial, so this is brand new people that are coming in. We recently got another 3.94 million people who filed for unemployment. Right? These numbers just seem like they're made up, but these are real people who are losing their jobs and getting a paycheck from the government because they can't work. And this is continued. So if you think that this is going down, because a lot of people right here when the lockdown occurred, that was the most amount of shock. Now you're getting the people who don't necessarily need to lose their jobs, but the companies can't pay for their salary. So they have to let them go because business is not doing good as they used to because the revenues are decreasing, the profits are getting squeezed. They have to do something, and that would be laying off people. You can see the stragglers of the company still laying off people, and the continued claims. This is adding on is increasing. So we're seeing, 18 million people, if you're continuing the claims, 18 million fucking people who are just now unemployed. That's absolutely staggering. And what number will be important, I think that's going to be coming out, is going to be the non-farm payroll and the unemployment rates in terms of a percentage. That's going to be coming out next week. We can see right here, obviously, this is not going to be the exact number because we don't know, but in terms of what we could be seeing for the unemployment rate, expectations for the April unemployment rate are in the 10 to 15% range. That's crazy shit. Look at how fast 2008 was, right? It went from, let's say when it started, December 2007, January, March, spring of 2008, we saw 5, 5.6, 5.8, and this is on a monthly basis, right? We started seeing it slowly rise, 5.4, 5.8, 6, 6.1. This is the biggest jump, 6.1, 6.5, 6.8, 7.3, 7.8, 8. You see a slow rise in the unemployment, right? You're seeing that. It seems steep, but it's not that steep. If we even zoom out further, you're seeing each month there is a steady rise, which is somewhat normal looking if you're looking at the grand scheme of the unemployment rate. But what we're seeing right now is, let's just go back to where we are. Let's zoom in a little bit more. And this is 2008, right? We saw how steady that was. Our previous was 4.4 for March. What we're expecting is between 10 to 15. So this line is going to be a straight fucking line up all the way to around here or even higher. So if we zoom back all the way to pre-1950s, 1948 was when this chart was created. We're going to see more people unemployed as a percentage of the total workforce than any other time pre-1950. This is Great Depression numbers in the shortest time span we've ever seen. So this is why, in my opinion, it's still a shock to people. Like, people can't accept it. I just don't really understand. But looking at the actual economic data that is coming out, the economy is going to be a worse shape than we saw in 2008, we saw in 2001. It's going to be comparable to the Great Depression. In my opinion, yes, other economists are saying this, and I agree with them, because it's not just a fairy tale question that is derived from absolutely nothing. It's looking at the hard numbers that are coming in through the federal government, looking at how much of an impact this has on the economy. And we can see it's completely unprecedented. These numbers are breaking charts. Look at this chart. It literally broke the chart. We've never seen a number like this ever. And the entire time this chart has been around since pre-1970. It looks like it's completely flat before this number. And if we take it out, it looks relatively normal, right? How normal does that look? Like a lot of other charts. It goes up and down. We have these highs, we have these lows. The economy's been going somewhat steady, and then we get 2020. Just unbelievable. Absolutely unbelievable. So yeah, that's personally my view. We also have next week the NFP, non-farm payroll. If you don't know what it is, I believe this measure accounts for approximately 80% of the workers who contribute to GDP. The measure provides useful insights into the current economic situation because it can represent the number of jobs added or lost in an economy. So we see a little bit of a dip. This is dating back all the way to 1939. Wow. So then, yeah, you see these dips. 81 was a dip. 2008 was a dip. 2001 was a dip. Let's just go to the previous couple decades here. This is excuse me, I'm going to get a little bit of coffee and then I'll continue on here. So this is 2008. We got a pretty big dip. This was from February to March. We got a little bit of a dip. Surprising, because we really started at March was when we really started that capitulation. So this upcoming month will be a very important one for the NFP, although I don't really know how much it's going to impact the actual markets, because some of these larger corporations within the S&P are actually holding the S&P up. Look at Amazon, Microsoft, Google, or Alphabet. A lot of these companies that are able to provide services in the digital space are actually doing really well. Amazon broke all-time highs. Microsoft is doing really well. So yes, some of these companies are actually keeping the market up, but yeah, in my view, it's still somewhat of a confidence game. You can't have this many people losing jobs, complete lockdown, and that's just COVID. Look at oil. It's just does not make sense to me that it's continuing to go up. So that's not a problem. I'm going to hold on. I don't really have any exposure within the S&P. I don't mind sitting out, waiting for a better opportunity to enter my short trade. But for now, I'm just sitting on the sidelines. So let's now go to the price action of the S&P. First, let's go over the daily chart. So this is where I got stopped out. We did see the wick go above the 61.8. I just closed it and saying, hey, I think it's gone a little bit too far, especially when we've got above the 2880 zone. When we broke above this, let's just take a picture and just discuss what I was thinking during this whole market move up here. So let's just take a picture of the S&P. Initially, I had here, 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 and here as a nice level of support, and it did hold for a while. We got a pretty big gap down right here, which I was pretty happy about with my short, and then we got a pullback validating this key level of supply. We did get this candle right here closing right at the 50% level, leaving only a wick. That, in my opinion, I did add more size on the Discord when that came into fruition. I did not have this trend line coming in just yet. And then it started moving up, and we saw initial job loss claims come into the market during kind of this time, and we saw the price really not get affected by it. And I was kind of thinking to myself, scratching my head, there's a lot of people who lost their job. The economy is obviously not doing great. Lockdown is still fully in momentum. I just don't know why it's going to go up. And it still continued to go up. Once it broke this level, I definitely was a little bit worried. And when that open came in of the high, I said, you know what? Right now, I don't feel comfortable and I don't have nearly as much confidence in the market to go down. So I'm going to take off my position, eat my loss, take that as a learning experience and say, you know what? I have favorable risk-reward situations. As long as I'm able to nail one entry, if I take one failure of a trade or even two failures of a trade to get that good entry, I'm willing to hold it because the risk rewards are very favorable in my personal view trading this current setup. So that's basically the kind of overarching view that I have. We're still in the supply zone. I'm still not going to change my bias just yet, but I'm very cautious of entering longs or shorts because I just don't know what's happening right now with fundamentals looking bearish, but obviously the market's still moving up, grinding on this little support line, so I'm just not ready for an entry just yet. So looking at the futures or the CFD, contract for differences, which are 24 market on weekdays, not actually 24 hours, but very close to it. But we can see there's less gaps in the market, and then let's just take a picture of it yet again to discuss what we saw. So we got a break in that support, and now what I'm kind of looking for is just failure of a move to the downside, but the main level of support I'm looking for is 27.50, around there. That's going to be the main level of demand that I'm going to be looking at. The price could continue to go up a little bit higher, hold this trend line. I'm not really looking for any shorts because I do think if the momentum does turn to the downside, and there is worry of another leg down, it'll be a pretty quick fall from the major structural support that we've been holding, which is around 27.50, to at least 22s or like 23s, somewhere within this range of that low. And that's a very significant amount of profit that we could be looking for if we're able to manage our risk, maybe get a 3, 4, 4.5 risk reward, looking at the risk here, looking at the potential reward here. It's looking pretty favorable, right? But ideally, because I was too early for my short for the S&P 500, as well as the fact that the sentiment is looking a little bit more bullish in the short term, looking at some biotechs and some pharmaceuticals gaining some traction for momentum to the upside, looking at some earnings that wasn't great, but they beat earnings on some of the major tech stocks. So I'm going to remain very patient. I'm now using this resistance. I guess if they extended it a little bit further, it was a support, but we don't really need to say that. It initially was a resistance, turned into a support, turned into a support, turned into a support, and now it is currently used as a support. But at this point in time, I'm not really looking to short the market. I'm waiting for more of a confirmation and momentum to the downside before I look to really add on any more size. But right now, just looking at this to see how it reacts, because right now we are holding a previous resistance, which is now going to be new level of support. So I'm seeing how that works, seeing how that reacts to the prices, or the price levels. But at this point in time, I'm going to be very cautious. I'm going to patiently wait, because if we look at previous market crashes, it does take some time for it to start to correct. But we can afford to have 1 or 2 losses in this trade, because we know that if it does inevitably go back down, our risk reward parameters we're setting for ourselves for our trade plan allow us to be profitable trading this setup, even if we lose 1 trade or 2 trades. Obviously, if we lose 2 trades, our profitability for this setup is not going to be favorable. It will be profitable, but not to the level that we'd like. So this next trade, this next entry, we'll definitely want to be patient. We'll want to be making sure that we have a high dependability for this next trade entry, and we'll notify our Performante Premium members for this setup. But basically right now, I'm going to remain a little bit more patient. My bias is still bearish. We went over the economic statistics that are coming in as we speak. They're not looking favorable. They're not looking great. They're looking bearish. They're revealing the underlying outlook and health of the U.S. economy, which is not great. That's basically analysis. I hope you enjoyed it. I don't really have much more to say. Let's just see how it goes. I will be looking at the comments in the YouTube section, but I will close the recording and then I'll post it within the YouTube section below. So thank you very much for watching. I hope you enjoyed it. We've been getting more engagement within the comment section within the YouTube. I appreciate it. Some people were real kind and gave some nice warm-hearted comments in the previous post. Didn't mean it to be like sympathetic or anything, but just kind of providing depth into the actual reality of trading, because I know that a lot of people assume that trading is this get-rich-quick scheme that takes a month to turn your $100 into $10,000, and then in the next month you're going to trade it into $100,000, and you're going to be a millionaire super quickly. And you just need to follow a simple signal service. You just need to follow a simple trade plan of crossing MAs, RSI divergence, whatever the case may be. And it's really, really more than that. It's to be completely honest, a lot to do with psychology. Once you kind of grasp the TA, the fundamentals, and kind of how you build narrative into your trade plan and have bias and be able to manage your risk, manage your portfolio for a long period of time, that's just all learning through someone else. Like, someone can teach you that. But for psychology, for understanding your own self, that shit is another level. It's another ball game. And I think to some degree, you can't really get taught how to manage your own psychology. Yes, you can get tips, you can get tricks, you can get tools, you can get ways of trying to mentally reset, trying to change your bias and all that stuff. And it is helpful, but it's a lifelong process. It really, really is. And you got to learn the hard way. You got to learn from failure. You got to basically reflect on pain you've had and say, okay, I don't want this feeling again because it really was shitty. How do I make that happen? How do I try my very best to not feel this pain again? And Ray Dalio's book Principles is a great way to try to identify and solve those issues, because if you don't get to the root problem of them, you will continually make that mistake. So thank you very much for watching. I will be going over the YouTube comments, and until next time, have a good one, traders. Alright, so that is the video of the day. A little bit quicker for today, just going over some economic stats that came in, going over some stuff that already have come in, and discussing what will be important in next week and kind of the next foreseeable couple weeks here. Non-farm payroll will be pretty big. Obviously, the unemployment percentage will be big, but we've seen the initial claims coming, and they haven't done shit to the actual stock market, so I'm a little hesitant on actually using that information at all. And to be completely honest, using any fundamentals at all, just other than the fundamentals look bearish, I don't think is a really good way to trade at this point, because they've been very, very unpredictable with how they've been moving the markets. Let's just say that. And, with more stimulus probably coming around the corner, we don't exactly know what the Fed will do. So, yeah, we got to be on our toes. We got to be flexible. We got to be nimble. But at the end of the day, my personal narrative is the market will go down. And we'll see. Almost hit 3,000. Very, very, very close to hitting 3,000. Let's just look at the... Let's just look at the next fib level that we're going to be hitting. 786. We got a ways to the 786, but I really, really do not think, we'll be going there. I didn't think that we'll be hitting all the way to the 618, but we definitely did that. So that's the next major fib level, which obviously is well aligned with where the little mini bounce happened there, but I'm going to take that off the chart and I'm going to be just looking at where we currently are. But yeah, I'm definitely surprised at where we are in terms of the height of the bounce, but there was a point in time in 2008 where the instruments that the main characters were trading, I don't know what hedge fund I guess it was, but it was Steve Carell and that hedge fund. They were short the market. The CDOs were going up, but people were paying less, or there was defaults rising in mortgages. So there was a decoupling from reality, and then when it came back, obviously we all know what happened at the end. So I think, in major recessions, there is a certain time where there's going to be a decoupling where reality isn't shown in the market, and then when that confidence is absolutely crushed, the stock market may overperform to the downside, going further or lower than it initially intended, meaning there's more fear in the market, which would drive it further than what true value, I guess, would be. And that's when you would have these major undervalued purchases. But let's now go to the questions here. Did you trade the pump yesterday for the market? No, I did not. I did not trade the S&P. I actually took my trade out and I just said, you know what, I'm going to be patient for this. Next man said, psychological number high is 3,000. I'm going to try my luck again at that level. Lol. Yeah, we'll see how it goes. 3K is right around here. I'm going to be patient. I'm going to be looking for that breakdown. So instead of a price level that it's going to hit on the way up, I'm going to be looking for weakness on the way down, which would mean that I'm breaking ascending zones, holding them as resistances. I'm breaking horizontal levels of supply and holding them as resistances. I'm making structural lower lows and lower highs on smaller time frames, and I see more sell pressure coming into the market than sell pressure. I'm seeing no demand candles on major levels of supply or resistance, ideally levels of support. I want to see no demand candles of levels of support to indicate that there's a lack of demand where there should be demand levels. That's what I'm looking for. We'll see how it goes. But yeah, right now, I'm hesitant on entering short until I start to see a breakdown within the chart. We've seen that the Fed pumping stimulus into market has proven to created confidence within the market. We've seen that for sure. We've seen that a lot of these major economic factors that should play a role in the decimation of the market cap has proven to been ineffective. So until we start to see that confidence start to shift and the market start to take a downturn, I'm just not confident enough to make that bet yet. So that's going to be where I have my psychology in place. So the next question, what do you think the possible high SPX? I think there's something. I think you forgot the Y or X. What's the range of time before we see a downturn? So time frames, I don't exactly know. I'm taking it day by day. I'm looking at the market structure in terms of the price action. I'm not setting a specific date on when I think the breakdown will occur. I'm looking at the price action to show me when it's going to break down. And I've already discussed what we're looking for. We're looking for ascending breaks. We're looking for market structure breaks. We're looking for horizontal levels of support to break. We're looking for VSA to confirm that bears are coming into the market and bulls are weakening. That's the kind of stuff that we're looking for. So, Yeah, fundamentals are kind of thrown out the window in terms of looking at the economic stats that are coming in because we know it's bearish for a fact. There's GDP contraction. There's less transactions going on in the economy. There is massive layoffs, huge unemployment numbers. We know the economy is shrinking. We know that for a fact. The only thing that is baffling to me is the stock market still going up, right? Yes, they're injecting shit tons of money into the market. That's great and dandy. But can they completely save the market? Can the Fed print their way to recovery? I don't think so. Japan tried it in the asset bubble when they had the 80s was the huge asset bubble when real estate and stocks absolutely ballooned. And in the early 90s, in 1990 and 1991, they had the asset bubble collapse. The Fed, the BOJ, the Bank of Japan, also tried 9 stimulus packages to try to stimulate themselves out of a deflation, out of a recession. They couldn't do it. And they've been in a deflationary spiral for over 10 years because of A, the governments, and B, the demographic cycle, and C, the psychology of the masses having a saving deflationary mindset, not wanting to consume. So yes, it's not exactly resembling the United States, but there are some similarities that you can extrapolate from the Japanese asset bubble collapse and project a potential hypothesis and a potential speculation for how this is going to potentially play out. So, yeah, in my personal view, there are some similarities. The Federal Reserve did act a lot more aggressive and a lot quicker compared to the BOJ, but it's like, in my opinion, it's like giving a drug user more drugs. Debt and credit in the short term is great, but in the long term, you're going to have to take away future prosperity to pay your debts off. And the U.S. is going deeper and deeper and deeper into debt. Their balance sheet is sure as hell never going to get nearly as low as it did in, let's say, even 2000, at the peak of 2008. There's no way. Let's look at the balance sheet of the Fed. Let's go to economic stats. Let's go to the monetary base of the Fed. Look at it. It's unbelievable, right? This is the peak of the quantitative easings that we saw in 2015, 2016, and they try to normalize, really not making any sort of dent, and now we are at the very peak. And in my opinion, this is just the starting of what will be another massive expansion in the balance sheet in the monetary base, except this time, we're not just giving it to Wall Street, we're not just giving it to banks, and seeing the inflation in real estate and equities. We're giving it to Main Street, to everyday individuals, and in my opinion, we will start to see the prices increase of everyday goods and services because of that. But we won't see it just yet because there is velocity decreasing, there is the lockdown, people are not transacting goods and services, but once things start to settle, and once the kind of easing of the lockdown occurs where the economy can start running again, people can start purchasing non-essential items a lot more frequently, then you will start to see the higher amount of units of currency fighting for the same amount of goods and services. So if you're looking at it from a simple supply and demand standpoint, if you increase the amount of currency available fighting for the same amount of goods and services, it's going to get an increase in price. And this is what you're seeing, right? This is what inflation is. It's not just increasing the pool, but it's also increasing the velocity pool so people spend more, so there's more interactions within everyday individuals and businesses, and that is the two ingredients needed to actually change these numbers. Not just the increasing money supply, but also the velocity of money, the amount of transactions that are taking place within an economy. So there's two things. So that's what we're really going to be looking for more of the global macro gold, silver, cryptocurrency space. The anti-fiat pool that we are looking at to be an extremely, extremely bullish opportunity in our lifetimes. I don't know exactly when. It could be a little while. We've seen a deflationary spiral where central banks have been printing a shit ton of money for a long time without seeing inflation, but I think it is inevitable. Look at the time frame of major currency collapses. Germany didn't take overnight. It took months and years for their franc to basically hyperinflate, right? It doesn't take a month. It doesn't take half a year. It takes a long time. And that's what we're going to be basing our thesis off of. So that's basically my viewpoint. Don't really have any other things going on in terms of the comments. Quickly, I think what we will do is look at this. Actually, we didn't look at this within the video, but I do think that this is still pretty important. I actually should have incorporated this into the video, but hey, for the people watching the live, this is a little bit more in-depth in terms of the global indexes around the world. Not every single one, but we see Canada with the TSX, we see Germany with the DAX, UK with the FTSE, US S&P, and the Russell 2000 is going to be these small caps within the market. And then all these are going to be large caps, kind of like the S&P, except different number of equities in that index, basically. But what else we can see is this red supply zone that I drew in for each of these indexes are going to be the 50% to the 61.8% fib level for the full recovery to the all-time high, or to the most recent high before we saw that collapse of the liquidity event and COVID, and obviously everyone knows what I'm talking about, who is following the financial markets. So for Canada, we have hit the 50% and actually went above it and are now within the supply zone of the 50% to 61.8. Very similar to the S&P 500. Germany just touched the 50% but rejected pretty quickly down. We see the FTSE 100, which is UK, not even hit the 50% fib level yet. And then the US has seen the best recovery in the entire real market, really, in terms of the different indexes. Canada is actually doing pretty well, but Germany's not doing well. Europe overall is not doing well compared to the Western countries of Canada and the United States in terms of the recovery to the high. And then the small caps did see a break above the 38% level, and now we are ranging, hitting that 50% fib level. So overall, the indexes are moving up. The West is seeing a better recovery than Europe, but overall, we're not seeing too much of a massive recovery just yet, like above the 61.8, but yeah, we'll see how it goes. I don't really have much more to say on these price actions. Let's just look at what we're seeing right here, what we're seeing right here, like so. It's not perfect, but we're seeing a lot of these corrections here come to a potential zone where we could see some hesitation to go higher because we are nearing our supply zone. So we'll see how the market reacts. But for now, we don't really have any shift in momentum just yet from any of these major indexes. So we're going to play it cautious. We're going to wait. We're going to be patient because, in my opinion, if you're able to survive this and be patient, manage your risk, be able to manage a portfolio so you're not overexposed in one asset, you're not taking astronomical risk assuming that you're 100% going to guarantee be right. If you're able to survive this, there will be some unbelievable opportunities in not so much equities, in my opinion, but more gold and cryptocurrencies, because those are going to be the huge price appreciation assets for the future, in my personal view. Obviously, it's a speculation, but in terms of how much money printing that is going on in the long term, I think that it's so bullish for BTC, and it's so bullish for gold. And crypto also has other avenues in which investors will be interested in partaking in the market. Safe haven / store value is only a part of it. If we're looking at cryptocurrencies in general, blockchain is able to provide a tremendous amount of value in many different areas of the economy. For example, just one sliver of what cryptocurrencies and smart contracts can do is basically not eliminate, But for taxes, for accounting, for creating up contracts that self-fulfill, like smart contracts, there is a huge disruptive sector that we haven't even touched yet for this type of technology. So there's a huge revolution that is coming that doesn't even need to be in the realm of digital safe haven assets. Blockchain is absolutely massive, and safe haven, store of value assets that are digital, that is like BTC, will be a huge player. But that, in my opinion, is a small sliver of the total possibility that blockchain offers. All right, last thing we're going to be looking at, Jed said, for the second quarter, Amazon said it could report operating losses of up to $1.5 billion, though the high end of guidance was $1.5 billion in operating profit. A wide range that shows the inability to project results in a difficult time. The S&P 500 barely moved. Yeah, so it's very difficult to project times for sure. But yeah, this is the level of uncertainty that we're seeing within the market. Yet the market is not really moving down that much. So I think if there is momentum coming into the market to the downside, I think it will be easier to shake off the bulls because you're already seeing the numbers, you're already seeing the true hard statistics that is giving you information on the health of the economy. It's not a guess. It's not like we're maybe assuming that there's going to be some contraction in GDP. We don't really know. This is a negative 4% or more than negative 4% GDP contraction within just the Q1 quarter, and then Q2 is going to be even worse. So once we start to see the true numbers actually come in, I think we will have a turn of events and a turn of sentiment. But until that occurs, I'm just not confident enough on entering short the market right now. So I'm going to be very patient. I'm going to wait for the sentiment to change. I'm going to wait for the structure of the price action to change within the SPX. But yeah, that's basically my analysis. Dow Jones hasn't broken the 618, which is good to see, although it did break that recent high of 24,320, right around there. So Dow Jones is still not really giving me any sort of confirmation that we are going to move to the downside, although we haven't broken the 618 yet, unlike the S&P. So that is a good thing for the Dow Jones compared to what we saw within the SPX. But yeah, at this point right now, I'm not looking for any trades. I'm just being very patient because I do think that the trade is still coming. The short is still coming. And hey, if I don't get it, if it just continues going up, I will take my one loss, move on, and accept it. Because at the end of the day, anything can happen in the markets. There's no guarantee. No one should be going all in 100%. That, in my opinion, is a very, very poor way to trade, assuming that you are going to be right as a guarantee. You can always be assured that there's going to be uncertainty in the markets. And as a job as a trader, you need to manage your mindset and your psychology while you are going through your mind of all the things that are uncertain, all the reasons why your trade should or should not work. So that looks like that's the end of the YouTube comments. Thanks very much for watching. We really hope you enjoyed it. If you found this useful, educational, entertaining, whatever you value this as, we really hope you enjoy it. If you think that there's anything else that we could provide in terms of value, in terms of opinion, in terms of our viewpoint, definitely don't be afraid to let us know, and we'll be sure to try to provide the most amount of value that we can. I guess we could talk about the US dollar index before we go. Was on this ascending horizontal or ascending kind of horizontal level of support. It did break to the downside with a pretty bearish candle. I don't really want to classify that as a confirmed break just yet because we have a lot of support right around here. So it could come down and then hold the support and then continue going up. I don't want to really assume that it's going to absolutely plummet just yet. But the US dollar looks like it could be starting to weaken here. But we'll see, right? Time will tell. I do not want to be just automatically looking short. We did get a little bit of a squeeze here where we saw One major rejection, two major rejections. We saw a nice little pennant push up. We saw a grind pushing higher, but we did end up breaking that zone. And then the fact that we broke the $100 zone is a pretty significant psychological area. And then it looks like we are breaking down a little bit right now for the strength of the US dollar. But I just don't have enough confidence that we are going to be moving to the downside just yet. So this is the daily. We can see initially we had not a lot of movement, just some consolidation slowly grinding up. This was that initial sell-off. And then that was where we had from March, early March, all the way until kind of mid-March. That was a huge sell-off within the stock market, within gold, silver, coffee, crypto, everything sold off. And that's where you saw, if you're selling gold, you have to be buying US dollar. If you're selling Alphabet, you have to be buying US dollar. So when there's a full-on multi-asset class sell-off, liquidation event, like we saw, you're going to get a massive spike in the US dollar, which we exactly saw right here. And we're starting to see some consolidation. I don't think that this is completely done yet. I think we could still start to see some sideways action here. But in terms of where we currently are right now, looks like we are dropping a little bit down, but I'm not really confident that we're going to start to see a huge loss of confidence in the United States dollar. A lot of emerging markets, a lot of people are still valuing the dollar because it has served as a means of a safe haven asset thus far in terms of the economic turmoil that we've seen so far. Obviously, it's done pretty favorably compared to every other currency. If you're like, the way I look at the United States dollar is it's the least shittiest currency out of all the other currencies. And it's the world reserve currency, so there's going to be a desire for that because people need it to transact commodities, goods and services. Looking at, like I just saw a documentary about the Panama Canal that's connecting east to west basically as the world, and their entire trading currency is in US dollars. If you want to buy coffee, if you want to buy gold, if you want to buy silver, if you want to buy crypto, if you want to buy any other altcoin, it's all based on the US dollar basically. Not everything, but a lot of it is. So as the world reserve currency, they're going to get a lot of transactions, right? So until that confidence is lost, I'm just not super bearish on the US dollar currency index. Although if you're looking at it from a macro fundamental standpoint, yes, 100% I am super bearish on the confidence and the value of the US dollar. Now, you got to assume that you're comparing it to something that's a little bit more hard, like gold, like Bitcoin. Yes, the US dollar will devalue very, very aggressively in the long term because how much money they're printing, which makes sense. But if you're comparing the US dollar to other currencies that are also devaluing, that are in debasement, then what does that look like? Because it's very difficult to gauge the confidence of a currency when you're comparing it to another native currency that is also getting printed into oblivion. So I think the FX market will be very difficult when this does occur, but for now, I don't really have any major outlook that I'd like to trade on the US dollar. But in terms of fundamentals, that's where my viewpoint is. Someone else has a great analysis. I'd rather be patient for now. Thanks. Yeah, I really appreciate it. This is just my viewpoint. I'm not saying that this is financial advice and you should or should not agree with me. This is just my viewpoint, my take on what's happening in the market, what I'm going to be doing. And hopefully, it gives you a perspective, even if it might not give you knowledge. I don't exactly know what this is going to be providing for every single individual, but a lot of shit's happening. But I just don't think hyperinflation and major inflation in the US dollar is completely imminent right now. I think it will occur, definitely, in the long term, but in the short term, I just don't see that coming into play just yet. I think there'll have to be some sort of a catalyst. I think the next catalyst will be more of an economic bank-driven catalyst, kind of like 2008, where right now banks are getting squeezed. People are not paying mortgages. Loans from businesses are not getting paid. You're even seeing like random things, like you're seeing brokerage services get squeezed in profit because so many other brokers are able to provide free trading. So then TD Ameritrade, for TD Bank, they're having to lower the cost and lower the revenue for their trading services to allow free trading. Stuff like that. Banks are definitely getting squeezed. So let's look at another economic stat here that has not come in yet, but will be important as time gets as time goes on. Delinquency rate on single-family residential mortgages, mortgage delinquencies, delinquency rates on all loans, leases secured by real estate, delinquency rates on all loans, leases, all this stuff. Just general delinquency rates is important. We haven't seen it. It's a quarterly end of period statistics that's going to come in. We haven't even seen Q1 of 2020 yet, but this will be interesting to see how it's going to play out, seeing how many people don't pay their real estate mortgages, domestic offices, all commercial banks. This is going to be a very important number because this is going to show you, to some degree, if banks are just basically absolutely getting wrecked, which in my opinion they already are. They've already lowered the the fractional reserve rate, to 0%, where the amount of money that the bank needs to hold for you is 0%. Absolutely nothing. If you deposit $100,000 into a bank right now, they could lend that $110,000 and then some to Fred, the next guy who comes in who wants a loan. And they need to keep absolutely nothing in your bank account. And you think that this, I think FIDC, it's the insurance, I think it's called FIDC. Insurance, FID, Federal Deposit Insurance Corporation, FDIC, sorry. It's an independent industry created by the U.S. Congress to maintain stability and public confidence in the banking sector, right? This guy right here. Federal Deposit Insurance Corporation. Everyone says, when I talk about bank runs, when I talk about people saying, banks don't have that much money in their actual reserves, they always point to this and say, Federal Deposit Insurance Corporation, they will handle everything if banks go under. You are guaranteed money. You don't have to worry. If you have over 100 grand, I think that's the maximum amount that they insure. But if you don't have 100 grand or over, you don't need to worry. There's zero worry. But you think that the FDIC has enough money to basically provide money to all banks if they all fail, or if 5 major banks fail? Hell no. They don't have enough money to cover 3 banks. Look at the numbers. I don't know them off the top of my head, but they can cover maybe 1, 2 banks failing. And if you have multiple handfuls of large conglomerate banks failing, they can't fucking bail them all out. So what are they going to do? They're going to print more money to bail them all out. That's basically all they're going to do, which is going to even put more stress and the lack of confidence within the US dollar, which is, again, super bullish for gold and cryptocurrencies. So a lot of shit happening. Obviously, that's not a guarantee, but bank runs have happened in the past. Just because they're insured, look at the actual insurance policy. How much does it cover? Make sure that you know how much is covered for your bank, and be safe, basically. I don't really have much else to add on this video. We really hope you enjoyed it. Until next time, have a good one, folks.